it's been a powerful one-way move, and we are just seeing a little bit of pullback. We can sort of go on with levels and how maybe support lies maybe another 200 points lower from here, and we'll do that with Anuj Jain a little later in the show. But I just want to say that this has been just a one-way up and up move, and what we are seeing is just a pullback. The underlying sort of reasons in terms of expectations of strong earnings, etc., if anything, have only been met so far. It's still very early in the result season, but the point is earnings have been super all through, at least from the large cap names. Let's actually put some of those points to Pramod Gubbi of Marcellus Investment Managers. He's joining us right now to tell us if the market pulls right back or it sees a little bit more in terms of correction. Pramod, I know you're not, too much of a very near-term, short-term kind of guy in terms of predictions, but just a quick word on whether what we are seeing is just, for the lack of a better phrase, fear of heights, or you think this is, serious underlying concerns about valuations having run too high, fear that earnings will not catch up and that kind of thing.
Well, I wouldn't know if it's either, but I think the latter is far more sensible. I think the sort of low-hanging fruits of this rally are pretty much taken now, because now we've had the sentiment drivers of liquidity and the fact that we've got good news around the vaccine, at least concerns around the coronavirus-driven lockdowns are behind us. We've got positive news from the US in terms of the presidential election. So a lot of that is largely sentiment drivers. Now we need to see actual performance on the ground in terms of fundamentals. And I think Q3 results will mostly be positive because it had a couple of drivers on the demand side, whether it's festive demand or pent-up demand, given it was pretty much the first quarter of the lockdown opening up. And during the first couple of quarters, a lot of companies had cut costs. So you will see significantly strong earnings numbers coming through. The question really is whether the demand will sustain post this festive and pent-up demand, and can these companies operate on these sort of cost basis? I think that's where the market will become less broad-based and will become more dichotomous. And I think this is a lesson for all of us. I think it is important at this juncture to make sure that you are positioned appropriately in the right companies with the strong fundamentals, who don't necessarily rely on a broad-based economic recovery to drive results and therefore performance and returns. And I don't think it's ever happened that all companies have performed equally. And so far what we've seen is the share price rally has been pretty less discerning. And we're at this juncture that the fundamentals will come to the fore, and one needs to be a lot more discerning on what sort of companies you bet on.
Okay. Pramod, hold on over there. I really want to talk to you about banks and NBFCs, and given what sort of Bandhan told us, whether that's a micro problem limited to only one set of banks. But before that, NBFCs are very important, because another cue that the market will have to parse over on Monday is this discussion paper that the Reserve Bank has released post-market hours on Friday about a new framework, a regulatory framework for NBFCs. So let's go across to Lata and understand the details and the fine points there. Lata?
Well, there are actually at the moment we don't know who will fall in what category, because identification of which are the sensitive NBFCs is still in the form of weights. The NBFCs have been divided into three parts: upper layer, middle layer and base layer. Base layer, not much of a problem. They are all, assets under 1,000 crore. So you can ignore some 9,200 NBFCs can be ignored. Just 200 NBFCs are important. They could be in the middle and the upper layer. Now, for them, there is no CRR and SLR. That is the big relief, which was the big worry for the market. But there are some other restrictions, and I think this will be more impacting the real estate sector than the NBFCs themselves. Okay, now, before I come to that, capital may be increased. That is, of the total 15% capital they have to hold, equity capital could be mandated at 9%. It may not be very difficult or for most of the NBFCs, because they anyway want AAA rating and they would have had a decent amount of equity capital anyway. But that now could come as a rule. And then the other rules are basically governance rules. That is statutory circulation of rotation of auditors every 3 years. And then exposure norms, that is large exposure framework is available for banks, is imposed on banks. It was not there on NBFCs. Now for large exposures, there will be limits. You can't be overexposed to any one entity or one sector. Measures like that may come. Now, where I think it's going to be market moving is in terms of exposure to capital market and commercial real estate. Now, for the middle level and the upper level only these apply, that is for the top 200. There will be board approved limits for capital market exposure. So, funding of IPO or funding just to buy shares, promoter shares, the kind of problems that led to that, the Everready case, the SL case. So funding entities to buy their own shares, that perhaps will be limited by board approved principles. There will also be a limit on commercial real estate funding, separate limits for acquiring land, a sublimit could be imposed. All this coming from the board and disclosed to the stock exchange and the general public. Also, restrictions on grant of loans for buyback, grant of loans to directors and relatives, officers and relatives of relatives of senior offices, and to real estate. So my sense is, I'm just giving you a broad idea. All these are not yet rules. We still don't know who all it will apply to because it is a sensitivity analysis. How large is the NBFC? How interconnected it is? And how complex it is. We don't exactly know to whom all it will apply, but it is very clear that loans to real estate is going to find some restriction after the rules are formed.
Any change in NPA classification at all, Lata?
So it was 90 days for large NBFCs already. For the bottom of the pyramid, the large 9,000 companies, it used to be 180 days. Now it is going to become 90 days. But they are very small. They really are not stock market sensitive.
Okay. Got that, Lata. Thanks very much for that analysis. Now, Pramod, you anyway own one of the marquee names. You guys have been big bulls on Bajaj Finance. So I don't know if this is going to make you sit up and, look at your calculations any differently at all. But your thoughts on what Lata just explained, and actually also on Bajaj. They came out with numbers. The market's looking at the glass half full rather than half empty.
Yeah, I don't think this would affect. In any case, Bajaj is significantly excess capitalized, right? So they're operating on a debt to equity of 4:1, which means the capital adequacy is something north of 20%. Given that even if it goes up to 9%, I don't think we are anywhere close to that. So they're more than well capitalized. Nor do they have much exposure to capital markets or real estate. They, of course, have a mortgage book, but not directly to commercial real estate and so on, other than maybe a loan against property. So I don't think this is relevant. I think the overarching view, like Lata mentioned, is around governance, which was much required for the sector given the events of the last 2 years where we had situations around IL&FS and Divan Housing. And given that these were not really small NBFCs, given how much they were borrowing from the wholesale market, they were systemically important. And it was time that the rules around governance for some of the large NBFCs were tightened. Bajaj, in our view, has been a well-governed NBFC that way. Of course, there are risks around the asset quality and stuff, but given the excess liquidity they are sitting, the excess provisioning they have made, we don't see any risk, and we continue to maintain our position in Bajaj Finance.
The coming week is also the last week before the big event, the budget. My colleague Sonal Bhutra is standing by. Quick 60-second primer on the key stocks and themes to watch. Sonal.
Well, absolutely. A lot of stocks will be in focus ahead of budget, and CLSA has put out an interesting note where they speak about 7 themes or 7 sectors which will be in focus ahead of the budget policy. First up, they talk about how an increased allocation will be positive for the sectors like steel, housing, real estate. We have infrastructure if there is an increased allocation out there. And the biggest booster for real estate sector this time around will be a hike in the tax deduction limit on interest on housing loans. So that is something that they are watching out for. The second is the excise hike on cigarettes. So that is something that is a point of discussion every budget, and CLSA says that if there is a mid-single digit hike in the excise on cigarettes, ITC will be able to manage it. Third, they talk about the recent farm agitations and the farm bill laws and the protests around that, and if that could lead to higher agricultural spending by the government. It could be possible for the likes of Imami, HUL, Dabur and M&M. So watch out for those stocks according to CLSA. The fourth point is what they talk about are the import duties that the government is talking about on some products like electronics. That is to boost domestic manufacturing. But the steel industry is also very hopeful of a cut for the duty on coking coal. And consumer players are optimistic of some relief on import of palm oil because India is one of the biggest importers of palm oil and the rising prices have been a big issue. Fifth, they talk about any clarity on the scrappage policy because there's been a lot of talk about that and the auto stocks have been gaining also in last few days. So any clarity on that will be very helpful. And COVID has led to increased focus on health. So higher tax deduction on insurance will be a boost for the insurance sector. So that is something that they're watching out for. And lastly, the PSU space. That is something that will be in focus because commentary on future plans, their growth prospects, the monetization of stakes, and any further details given by the government will definitely keep PSUs in focus. So that's the list for you, something that CLSA is focusing on.
All right, Sonal, thanks very much for that. That's micros, bottom-up, specific sector-wise commentary from CLSA on the budget. Pramod, is the budget going to be important in terms of setting the direction?
Well, I mean, like we've always maintained, the budget is an annual account of the government's finances. It needs to be done, nothing beyond that. But this year, I think, given what the government's finances have gone through in terms of fighting the crisis, it is important to look at what the government's plan is to repair those finances, because we still need some more help from the government in terms of helping the economy recover. At the same time, we all know the reality around the government's finances, so we don't want that to completely go out of whack. So it is a tough task. I wouldn't want to be in the finance minister's position, but it can give us a sense of how say interest rates pan out given the government's own borrowing program. And therefore effects in terms of crowding off out of the private sector, availability of capital to the private sector given the government's financing. From those aspects, the budget is definitely interesting. There could be some element of reforms, but reforms, you don't necessarily have to wait for the budget to announce those reforms. The government has been at it over the last 6 to 9 months, so they can do that even post-budget. But by and large, our interest will be around understanding the fiscal situation and therefore the implications on interest rates.
Okay, we will watch out for those announcements and let's indeed see what that event leads us to. Pramod, we will wrap it up on that note for today. Thank you very much for your time. You have an excellent weekend and we'll catch up again soon. On that note,